Great. So, welcome everybody. Thank you for coming today to the webinar that's being hosted by CfPA. And so I'm very happy to have Sherwood Neiss, we call him Woody, who's here to chat with us and to give us this trends report. Before we go into that though, I do want to give a little background on CfPA and foreshadow some things that are coming up. And at the end, we will leave some time for Q&A because Woody is a wealth of knowledge, and it's a good opportunity for people to ask him some questions of things that are happening in the regulated investment crowdfunding industry. So CfPA, the Crowdfunding Professional Association, we are the leading trade association in the space, and we advocate, educate, and work to advance the regulated investment crowdfunding industry. And we do that through webinars, we do that through in-person events. We do that through advocacy with folks on the Hill and the regulators. And we are doing that with sort of online programming as well. And we have a very full year ahead of us and a lot of other things that we'll be doing. I want to foreshadow a couple things that we're co-hosting. We will be co-hosting an event called Super Crowd Baltimore, March 21st, that will be coming up. And I would recommend that anyone who's interested at looking at the intersection of impact investing and crowdfunding could go to thesupercrowd.com to learn about that event. We will also be co-hosting the Supercrowd 24, which is a virtual event, April 17th and 18th. So I'd encourage people to take a look at that event as well. We hold approximately monthly webinars, but we are this year returning to a place we were pre-COVID, and that is to have an annual summit. So please stay tuned because we expect to have a Washington, D.C. summit in the fall sometime, probably about the third week of October. To learn more about CfPA, we'd recommend you go to cfpa.org or the crowdfundingecosystem.com, where you can interact with experts. You can learn if you're a beginner or just a novice wanting to learn about crowdfunding, or if you're someone with some pretty nuanced questions. This is a good place to engage with the community. So now it's my honor to introduce Woody. Let me give you some background on Woody. He is known for co-authoring the Crowdfunding Exemption Framework, which became the basis of Title III of the U.S. Jobs Act, which legalized regulated investment crowdfunding. And he is at the forefront of the industry. He's done things from issuance to data analysis to secondary trading, working with liquidity. He has co-founded a company called Crowdfund Capital Advisors, CCA, which is a consulting firm that serves governments and multilateral organizations and done projects all over the world. He is also the co-founder of GUARD, which is the Edgar of financial disclosures for private companies. And he's general partner of D3VC, which is a venture firm focused on diversified investing among investment crowdfunding issuers. He is also the chief architect of C-Clear Regulation Crowdfunding Database, which tracks and monitors online security transactions for investors, regulators, platforms, and the media. And he is a co-founder and former board member of the CfPA. So we're glad that he's here. Thank you, Woody. And he's also part of another organization that was called the Crowdfunding Intermediary Regulatory Advocates. So he's launched a bunch of different things. He has a bunch of different awards and accolades. And I would probably spend the rest of the hour just listing those if we went over them. So rather than do that, I'll give people a chance to interact and hear directly from Woody, giving us a state of the union or a trends report on where things are. And so Woody, with that, I'll turn it over to you and let you go ahead and go through and give us information about where we're at in the world of regulated investment crowdfunding.
Great. Thanks, Brian. It's great to be here with you and the rest of the people here at CfPA. Just a fun side story. CfPA's origins came down to about a week before we were at the White House for the bill signing ceremony, when I got a call at the White House, who was our chief advocate within the White House. And he said to me, what's the industry statement on this legislation going through? And I said, well, I don't know. We don't have an industry organization. He goes, exactly. you need to form one in the next week and come up with a statement from the industry so that the president can use that when in his remarks in the Rose Garden. And so within a week, we had the Crowdfunding Professional Association up and running. So I always think that's
Glad you did.
a funny genesis to how CfPA came to be. And I love to see how the logo is still the same. And it was in the beginning, it was, just a bunch of us just running around trying to figure out how to get this thing up and running. So it's great to see that CfPA is still here, providing a valuable need in the marketplace or solving for that need in the marketplace. And I'm thrilled to be with you all and sharing what I focus on now, which is a lot of not sleeping in order to stay on top of what's happening in this industry. So with that, I'm gonna share with you a presentation. I'm not gonna go through all the slides. I just want you to know because that could take forever. But let's go here into presentation mode and can you see that?
Yes.
Okay, perfect. All right, so we're going to talk about trends in regulation crowdfunding. And so what happened? Oh, I'm not going to really talk about me because I think Brian did a great job. I just want to really talk about CClear, which is the database that we created that collects information on all the companies that are raising money online. It's called Clean, Collect, Aggregate, and Report. That's what CClear stands for. It's 100% complete data set of every single Reg CF offering. We collect about 125 data points on each offering, including financials, the industry that they're in, valuation, and what we call investor sentiment. So we're looking at capital commitments on a daily basis, and we're looking at the number of checks written on a daily basis. And those two figures make really regulation crowdfunding and what's insanely unique in the private capital markets, because when you look at what happens with the Reg D offering, a lot, and I did one of these, for my private company before I did crowdfunding. It all happens behind closed doors. So you might have some investors, you might tell other investors that other people are interested, but with crowdfunding and regulated investment crowdfunding in particular, all of this is happening online. So you get to see the traction that's taking place. Now, if you're following that traction, you can see trends that are taking place. And that's where we really come in, because we like to see what are the trends taking place in the marketplace, where are investors deploying capital across geography, where are they employing capital across industries, which ones are hot, how are women and minorities performing in the marketplace. So those are the type of things that I'm going to talk about in today's presentation. This data that we've been collecting and aggregating is used by the SEC. It's been plugged into Bloomberg Terminal as of 2021. We do license it to individuals that want it, but it really forms the basis of this really lovely 150-page report that we worked on, which, mind you, in year one, when the industry got started, I wrote 8 pages on funding. And so the fact that this took an entire month and 150 pages just goes to show you how much this industry has grown since it launched. Just really quickly, CCA is right there in the middle. Like Brian was saying, there's 3 things that we're focused on. The crowdfunding data is at the top there. It forms the basis for really everything that we're doing. D3VC is our venture capital arm. Because we have all of this data and we look at it on a daily basis and we're like, wow, that's an interesting company. Wow, they got a really solid team. Wow, they've raised VC funding before. They've been in this industry before. We were thinking, if there's a way we could build a machine learning AI algorithm, maybe we can look for signals in the entire data set of companies that have graduated either on for a follow-on round of financing or outside of crowdfunding to see what those companies look like in comparison to the companies that are coming into the data set. And that's really what the algorithm does in short. It feeds us up on a weekly basis a list of those companies that we should be looking at that probably have those signals of companies that will exit. And D3VC then does that human layer of diligence on those companies, and we make an investment decision to invest in them. Guard is our solution to liquidity. Most of these what's great about a regulated investment crowdfunding is you don't have to hold on to these securities until there is an exit, which is, a merger, a sale, or an IPO. You can actually have liquidity for these securities after 12 months because we wrote that into the law. But you can't actually freely trade these securities unless you comply with state securities laws, because the jurisdiction for secondary trading really comes down to the states, not at a federal level, because there's no federal exemption that exists currently for secondary trading unless you're on, New York Stock Exchange. So GUARD enables these exempt unregistered to trade by providing ongoing information about the company and their financial wherewithal for investors. And that's a key component for state security compliance, which states that these securities can be traded back and forth if investors have the most up-to-date information about a company. And that's what GUARD does. It publishes that information in EDGAR. So we're working on a lot. It's pretty exciting. I do want to just mention a few things about the data set. We look at what an offering is when we're collecting information. So we're looking not only at regulated investment crowdfunding as of Reg CF in the law, but we look at deals that might be parallel offerings. So they might be doing a 506c offering as well. And we're seeing this more and more with these offerings that are taking place. And a 506c is an accredited investor offering. So you can group people into two different ones, and it allows you to raise more than the $5 million cap. And like I said, we're seeing a lot more of it. So our numbers aren't just Reg CF alone. It's Reg CF and 506c. We don't do Reg A. Well, I mean, we collect information on Reg A, but we don't really focus on it because not all Reg A deals or Reg A plus deals happen online. So it's very hard to have a complete, accurate data set of what's happening in the industry. And when you talk with data analysts, particularly ones that do research and reporting on this, they want to have 100% complete data set. One of the ways in which you have to look at this data is not just at an aggregate level, but you have to really dig down to the granular level. And what I mean by that is you have to look at where these locations are, the deals are happening across the country. And then you have to break it up in terms of pre versus post revenue, startup versus established. And this really comes into what I'm going to be talking about valuations later on, because you can have valuations for all the companies that are in the data set, but that doesn't really mean much. You really need to look at the type of companies that are raising money, what stage of growth they are, what kind of revenues they have. And that's where you can learn more about it and have better comps for what's happening in the industry. That's the key thing there. So let's just talk about what's going on. And by the way, this information right here is as of December 31st, 2023. This data, as I said, grows on a daily basis. So what you're looking at here is just a snapshot as of the end of last year. But there's been 6,800 issuers that have run 8,000 offerings. So that means that you've got multiple issuers in there that are doing multiple rounds of financing online. We're going to talk about that because that's an interesting thing that where for one reason or another, these issuers are saying, I don't necessarily need or want to go to VC or other sources of capital. I'm fine staying within regulated investment crowdfunding and doing my rounds of financing there. And we're seeing this over and over again. And trust me, in the data set, you've got issuers that have done 7, 8, 9 rounds of financing online. So it's working for them. And I think this is one of the reasons why I'd like to see the cap go from 5 million up to 20 million, because it would allow those issuers to continue to use this mechanism to raise capital from the people that are closest to them. This is happening in all 50 states. It's also happening in U.S. Virgin Islands and Puerto Rico, the District of Columbia. So when you look at the number of states, it's actually more like 54, even though we only have 50. There's about 1,800 cities where we've documented these offerings taking place. $2.2 billion has been funded as of the end of last year. We're over 2.3 right now. 1.9 million investors, and these are your average Americans. It doesn't have to be your accredited rich investors anymore, but anyone that looks like you and me that lives down the street from you can be an investor in any of these businesses. And I think that's part of the exciting part of this exemption and regulation. These companies, they grow, they scale, they provide solutions, they solve problems. But more importantly, there's two things that they're doing, and that's these two figures right here. A, they're hiring people. So these businesses are creating jobs, and that's what's sort of exciting about this, because when we were pitching this to people on the Hill, when we were walking the halls of Congress, we're like, we want to speak to your people that are in charge of creating jobs. And we got everyone's ears listening to what we were talking about at the time. So to see that we've been able to create what we think is about 310,000 jobs, I think is just a proof point to how this industry is working. The second one is all of these companies have revenue, but more importantly, they have expenses. Payroll is one of those expenses, but they also buy products and services locally, and they have all these expense items related to their operations. Those expense items, when the checks are being written to support the business, a lot of it is being written to other suppliers that are local. And what's important about the $6.8 billion that's being pumped back into our economy is it's being pumped into local economy. So it's great that collectively our entire nation benefits from about $6.8 billion annually today. But that's not the story. The story is that's spread out among where all these companies are located. And so when you talk to government officials at the local level, one of the things that we keep on saying to them is you should really be thinking about this from a jobs perspective and how you can have more economic stimulus in your local communities. And that's one of the areas that I really like to focus on. Now, the next two things are just really what's in it for you. If you're an investor in this space, I think there's a lot in it. Anyone that's done any research, and we, of course, with D3VC, we've had to look into this. Early stage funds far outperform later stage funds. Why? Because the valuations tend to be lower. So if you get in earlier and they have the exits, you're going to do well. So there's been $2.2 billion that's been invested into these companies. They have an enterprise value currently of $75.6 billion. And that's based on the latest round of financing for the companies that have done multiple rounds online. So that $75.6 billion means someone's getting rich. This money will come back to investors. Not all of them, many of them will fail. That's always the case. But within a data set of this size and magnitude, we're already seeing the seeds of riches happening. You've got paper returns that are happening with companies like Boxable. They did their first round of financing online at a $42 million valuation. They've graduated out of regulated investment crowdfunding. They're at about I think they did a Reg A deal recently where they're a $3.3 billion valuation. So if you'd put $25,000 into that in the early stages, that would be worth over $2 million today. So there's a lot of value that we're going to start to see over the next few years coming back to investors. And the reason why I say over the next few years is because this investing is no different from venture investing. These are early stage companies. When you put your money into it, you have to wait 7 to 10 years realistically for that return. We're really at that 7 to 10 year mark now, where the industry's been around. It started in 2016. So we're a solid 7 years in now. And so now we're going to start to see probably those earliest companies, they don't have to be the earliest ones, but we're going to start seeing a lot more exit activity happening in the marketplace, which means the paper returns actually become cash returns, which I think is exciting. And the compounded annual growth rate, even though I'm going to talk about the slowdown we've seen in 2023, is about 59%. So that's healthy. And this industry is going to continue growing, I think, at that type of growth rate for the next decade, as far as I'm concerned. So let's start digging into some of the numbers and the trends that we're seeing. This one looks at really the deal count over time. The industry started in 2016. There were less than 250 deals. We were averaging over 1,500 deals up to 2022, and then we had a pullback in 2023. This pullback, I think, is tied to what sort of happened in the private capital markets when VCs also decided, we're going to pull back on our investing. Silicon Valley Bank crashed. We had really spiking interest rates. There was uncertainty in the public markets. Investors were weary. And so I think this had a trickle-down effect on issuers who were like, maybe this isn't the right time for me to go out for a round of financing. So we saw this pullback in 2023 that I think we're probably going to see reverse in 2024. So if you look at that very last bar at the very bottom of this chart, That's Q4 2023. And you can see how deal activity has picked up in Q4. So hopefully we will start to see this turnaround happen in 2024. I still think it's going to be correlated a bit to what's happening in the venture marketplace, where VCs are really slow to be deploying capital. So issuers might be slow to be coming online. I like to be thinking and telling people, you know what, if VCs aren't stepping up to the plate to provide the capital for your deal, there is this industry called regulated investment crowdfunding that can provide that lifeline for you. So you should be looking at that. I think that's a marketing message that we as an industry need to be pushing out there so we get more people actively engaged in this. But I think it'll be sort of slow in the first half of this year, and hopefully the second half of the year, we'll see a lot more issuers coming into the marketplace. This chart is just really fascinating because it tells you what I was just, it depicts what I was just telling you, which is, the VC, that yellow line, is the number of deals that they were doing. And that really started to trail down in Q1 2022. But at the same time, when you look at the deal activity for regulated investment crowdfunding, that trend line, and there was a spike actually in Q2 2022 in the number of deals, but it's been trending up. So VCs are pulling back, but investment crowdfunding is not. And I think, that's a positive sign, and one that we should be talking about as well. This one, now I really just want to talk about, one of the things that irritated me most when we were talking about this early on is people were saying, well, this is going to be the worst of the breed type of company coming online. It's going to be the riskiest. They're probably all going to fail. 50% of startups, according to the Bureau of Labor and Statistics, fail. So it's just, investors shouldn't put their money into these companies. And I really didn't have data at the time to argue with them until now. And I've got several data points over the next few slides that will take that argument and just put it in the trash. One of them is, if age is a sign of risk and younger companies that have less experience are more inclined to fail, then the converse arguably is true, that older companies are more likely to stick around. I know there's a statistic out there that, and I have to find out the source of it, but it's something like if a company's been around for 5 years, it's nearly impossible to put it out of business. Granted, you can have something macroeconomic go wrong that puts it out of business. A founder could die or something, and that might, put a company in harm's way. But for the most part, it's going to be hard to put it out of business. This chart is showing you that the average age of issuers has been increasing over time. So it was 2 when the industry started. It's now over 4 years old in 2023. I'm going to be really excited when it gets up to that 2020, when it gets up to the 5 years mark. This is another thing, startup companies are riskier than established companies. The dark blue at this chart is your startup, and the light blue is your established companies. So when the industry launched in 2016, 73.4% of the issuers were startups. Okay, yeah, that's really risky. The chances of them going out of business was probably really high. Now, fast forward to 2023. 47.65% of all the companies are established, meaning they're over 3 years old. Now, what's key about this too is that 3-year mark we use that as the distinguisher between startup and established, because that's what you need to have that's what you need for experience in order to get a loan from a bank. So if you walk into a bank and say, I'd like to apply for a loan, they're going to say, yes, perfect. Let's get 3 years of financials, and then we'll run you through our diligence process. And you're like, well, I'm a startup, I don't have 3 years of financials. They won't say no. They'll probably just say we need 3 years of financials, and then we'll run you through the diligence process. It's their way of getting out of not having to give loans to startups. So it's nice to see that we're seeing more established issuers come into the marketplace, because these are companies that can probably go to banks, that are actually turning online for capital rather than going to traditional type of sources. And this is another proof point. The average age of revenue by year is growing over time. I mean, it's crazy to see how 2023 I had the average revenues that were over $1 million, when in 2016 it was well below $250,000. So the companies are looking at this differently. They're like, we are making money. We need capital to scale and grow. There's alternative sources out there for us, and we're going to go online and raise that capital. And that's what we're seeing from these companies. So that's what this chart is showing you, that we've got companies that are, over $1 million raising capital. I will tell you, there's companies that hit the $3 million mark and companies that hit the $5 million mark. Many of them have revenues much higher than the average 1 million. And so it's fascinating to see that those companies are in the marketplace as well, because clearly it's not that they need capital per se. Maybe they need the investor's voice that they're getting from having this, investomers on their cap table. This part really talks about the pre versus post revenue issuers, which is another way of looking at risk. So in the beginning, your pre-revenue issuers, the dark blue, made up 63.3% of all of the offerings. In 2023, your post-revenue issuers made up 63% of all the offerings. So complete flip. It's great to see that, I can have the argument that people are like, these are just risky companies. And I was like, well, a startup that doesn't have any revenue, that's pre-revenue, you're right. It's very risky. But the fact that 63% of the companies in 2023 were post-revenue sort of puts an arrow right through the heart of that argument. And I can say, well, I don't know. I can argue with you that these companies are less risky because they've proven that customers want to buy their products or service. And I think that's another great thing about this industry. So this industry in 2023 had 41.7% of offerings with at least one woman or minority founder. That right there should be a cover story. Because if, I know this, maybe many of you know this too, but, if you go to Silicon Valley, you talk to VCs there and you look at them, they're all white men. It's a white man's game. They invest in other white men. It's just been this thing that's always been the case. And to see the diversity that we have in regulated investment crowdfunding is amazing. And not just because these people, these founders are getting capital, but they don't have to go to VCs. They literally can be like, okay, I'm going to go online, I'm going to go to one of these online investment platforms, and I'm going to list my offering, and I'm going to raise money. And what we're finding out through interviews with these offerings is they're raising money from people that look like them. So from other women and other minorities. And I think that's great because it democratizes to capital to these founders, but it's sort of a wealth generation opportunity for underserved investors in the marketplace. And I think this is just a beautiful data point within the whole thing. This is, I think, a really powerful point. The big companies, and there is a lack of compliance here, so I'll point that out, which I find it a bit frustrating, but companies that are successful with investment crowdfunding have to file annual reports. And so once you do that, and it's not that hard. I mean, it's sort of hard to log into Edgar and figure out how to do it, but you're just updating data fields. And if you give a brief description of the big changes that happened in terms of revenues, expenses, and all that stuff, you can probably get one of these reports done pretty easily online within an hour. So with the data set that we do have of the companies that have filed their annual reports, we can look at the revenue in the year in which they did their offering and the revenue in the year after they were successful with the round of financing. And what the data has shown is the average revenue growth between the year an issuer was successful and the following year is 284.5%. So there's a couple ways to look at this. One way is if you're an issuer that's interested in this, well, you might want to go down the path of raising money online because for one reason or another, your revenues stand to grow significantly year over year. Now, that might be from the capital that's infused that you can use to expand your business, but it also might be from the investor base that comes in and is committed to helping you grow. From an investor's point of view, they love to see this because a higher revenue is tied to valuation in many cases. You've got many different ways to determine valuation, but one of them is revenue multiples. So to see this average growth in revenue just means that your valuation or the company's valuation is going to increase over time too. And that's what investors really like to see. Back to my point about 50% of all new businesses fail within 5 years. One of the things that we did just within the last few months is we sat down and went through the entire data set, all 6,800 companies, to find out if they were still in business. And what we found after we were done with this exercise is only 17.8% of them have gone out of business. So if 50% of all startups fail, according to the Bureau of Labor and Statistics, you're better off raising money online through regulated investment crowdfunding because your chances of going out of business are going to be smaller. And I think that's another powerful proof point. So we're trying to get that type of message out there. I already talked about this slide in terms of, return on investment. Now let's dig into some of the other trends that we've been seeing. Capital really spiked up in 2021. There was a pullback in 2022, I think tied to the initial things that we started to see with supply chain issues in the marketplace and the Fed starting to jack up interest rates. With the stabilization that we saw in 2023, while there were fewer issuers and fewer investors, and you'll see that momentarily, the investors that stayed in the marketplace were writing bigger checks. And that's why we saw 2023. You can't really tell right here, but it was the best year for regulated investment crowdfunding for the industry to date. And it's over $500 million a year. And I think the important thing about this slide is, it took 5+ years to get to the first billion. It took 18 months to get to the second billion. If we can really focus on helping this industry scale and grow, it's going to be doing billion after billion, year after year. So we're well on our way to that. I think, our market awareness is our biggest challenge. Again, the investments, I think, we saw them spike in Q4. I think they're going to stay strong. And I'm already seeing that in the first couple of months of this year in 2024. So while, like I said earlier, issuers might not be coming into the market at the same pace that they were in the past, and we'll probably see a greater part of that in the latter half, I do see capital flows staying strong. And part of this might be due to, if venture capital is not deploying money, which means they're probably not out there raising capital because they need to deploy what they raised, investors still are interested in investing in early stage companies. And maybe that's what this chart is showing, is more investors are coming online to deploy capital than they are alternatively to the venture space. The $5 million cap has, I think, increased the average raise because it's, more established companies coming into the marketplace. That went into effect in 2021. So we saw that average raise increase to 450 in 2023. Yes, it's over there again. This number is just going to increase the higher the cap goes and the bigger the companies are that come into the marketplace. The one thing that I really like to point out about this slide is, we were trying to solve for the valley of death when we went to Washington, D.C. with this framework. The valley of death is like from $25,000. It's up to $25,000. People use their own money, their savings, their credit cards to fund a business. Then they tend to go out and raise capital from investors, but investors tend to invest in companies that need about $250,000 plus of capital. So that's where the valley of death is, $25,000 to $250,000. And so, we were like, well, how can we solve for that with regulated investment crowdfunding? And what this chart shows you is in 2016, it sort of did solve for the valley of death. But then in 2017 and 2018, we weren't necessarily doing that because the average raise, was still filling in that void there. But we far surpassed the 250,000 when in 2019 and beyond. So, I like to tell people all the time, the valley of death is dead. We don't have to worry about that anymore. This really shows you investor sentiment. So it's the number of checks that have been written into the marketplace. And it spiked really in 2021 with a lot of what was going on post-COVID and people trying to help support businesses. And then, with the supply chain issues, with the macroeconomic issues, with the wars that we've seen going on around the world, we saw a pullback in the number of checks written. So 2023 was a bit higher than 2022. Again, I think we're going to see more investors in 2023. I don't think we'll be where we were at the 2021 levels, but 5 years from now, we'll be far past the 2021 levels. None of these industries, whether it be medical savings account or regulated investment crowdfunding, took off from the start. It takes time for a market to evolve. And that's what these charts are showing you, is these bars and charts are showing trends, and they're showing trends that is a slow evolution, which I love to see, because people were talking about the Wild West. And what these charts are showing you is this is not the Wild West. It's a very logical way in which issuers and investors are coming into the marketplace and leveraging this exemption to raise capital and make investments. This is, you can see this downward trend here, which is the investors pulling back from 2021. But, we're starting to see these spikes in 2023, which makes me feel confident that 2024 is on that same trajectory. Although I'll tell you, the first couple months, it's been slow with the number of checks that have been written. So maybe they're going to wait for the latter part of the year. But like I was saying, fewer investors, record high total amounts that have been committed means that the average check size is growing over time. So it ended up about 2,000 in 2023. It was about a little less than 1,000 for the first several years of regulated investment crowdfunding. I do like the fact that the average check size is this amount, because it actually, puts a bullet in the argument that investors are risking too much. Or risking more than they can afford to lose. Arguably, someone that invests $1,000 in a company is not investing all of their savings. If they are, they probably should be rethinking about where they're putting their money, because this probably isn't the smartest area for you to be doing it. But on average, if it's $1,000 per check, I think we've got a good argument that there's a lot of logic in the investor's point of view from how much they're willing to put into these companies. But it's not about one investor putting a check in for $1,000, as we all know. It's about having 300 or 400 of them coming in with that check amount to really help you get to what you need in terms of capital and awareness. This average check size is just increasing over time, and that's what this chart shows. I think we'll have that same type of activity for the next quarter. Success rate tends to be high, but this is misguided in the sense that companies set artificially low minimum funding targets. I'm not a fan of it. I think if you're out raising money from investors, you need to be forthright in terms of how much you need to raise in order to hit your next milestones. And that should be reflected in your minimum funding targets. But we do see a lot of $10,000, $50,000 minimum funding targets. So it's not that hard. And if you look at the average raises, it's not that hard to exceed that. And that's why we see these very high success rates. Still, we can talk about a very high success rate as a positive feature of regulated investment crowdfunding. You can raise a lot of money. This chart shows you how many companies raised over $1 million through regulated investment crowdfunding over time. And that number of companies is growing significantly. If you raise $1 million regulated investment crowdfunding, I guarantee you there will be many a venture capital firm that will be very interested in what you're doing, because they want to know, how did you pull that off? Who are the people that are backing you? Why are they interested in what are you doing? What makes you so amazing that you're able to raise $1 million online from people? And so this is a great way to prove yourself before you go to VCs, if that is the pathway that you so choose to go down. What's fascinating in the data set, since we moved from the $1 million to the $5 million mark, is the number of companies that are raising over $3 million. And the reason I bring that up is a $3 million round is a solid Series A area. And so the fact that these companies are raising $3 million through regulated investment crowdfunding as opposed to venture capital says something about their desire, their need, why they're choosing this over venture capital. And I don't think they are, it's meant to be, separate. I think companies might choose it for one reason or another, but we can only do so much. Like 5 million is the max that you can raise each year. If you're going to really scale and grow and you have that opportunity to do that, you're going to have to go on for venture capital financing. Let me take a sip of water.
And Woody, just as you're sipping water, we're going to have Q&A for everybody to chime in, so feel free to queue those up. I am going to interrupt just for one question here and to interrupt the flow a little bit. You talk about how a lot of companies can start out by raising money and then perhaps going to the VC pathway. Aren't there also pathways where you could actually stay on crowdfunding your whole journey through a potential public listing? And if so, do you want to maybe reference that or speak to that?
Sure. I mean, that's like a Reg A offering. Like if there's a way in which you could just stay in this exempt area. I mean, well, a Reg A allows you to raise up to, $75 million through a tier 2 offering. And you can do it with both retail and accredited investors. It's a qualified offering with the SEC. So you do have to go to the commission and have them review and qualify your offering, not give it, the approval that investors should invest in it. It just meets all the criteria that you've answered all the questions that they would like to see for investors to have an informed decision. So you could do that, but you could use a 506C, which is a accredited investor only offering. So you shouldn't look at this as one and done. You're right, Brian. This is an on-ramp. This is you can get on here and you can stay in this pathway. You can do a Reg D offering, but if you really want to stay online, you can go from regulated investment crowdfunding to a 506C if you're ready to move on to really just accredited investors only. But if you want to stay in the realm of retail and accredited investors, you could do a Reg A plus offering. The only drawback that I see for Reg A plus offerings is you have to be large enough to absorb the time and costs related to putting one of those offerings together, because it's not cheap. You're going to need, lawyers, you're going to need accountants. You have to have, audited financials. So it takes a lot more time to put these offerings together, and you need to budget for that. But, I think it's a great way companies can leverage this. Okay, I do want to open it up for questions, but let me jump through a couple more slides, and then I think we can do that. This is what we talked about at the beginning. So you've got this cohort in 2016 of companies that were successful, and they were spending money, and this shows you how much money they pumped into the economy. So it was less than $250 million. It starts to gradually add in each year. And this is a cohort, but that 2016 company, like I said, it is still in business in 2017. So you have to cumulatively add these figures together to get to that $6.8 billion of economic output that's happening. And that's what I love about that. There's not that many areas where you can talk about the cumulative impact of something, but to show the cumulative impact of these companies that are staying around, continue to spend, which means that year over year, this has a big impact on both our global our national economy and our local economy. Valuations. They've been going up over time. People always ask about this. The median valuation was about 5 million, which is where I think a lot of startups should be raising money, particularly if you're pre-revenue and you haven't even sold anything. But we've seen it spike up to 14 million in 2023. Again, you have to break this down by startup versus established. By pre versus post revenue, you can learn a lot more. When you do it that way, I'll just tell you there's a lot of logic in the system, and your post revenue established issuers, so those that are over 3 years old and have revenues, higher revenues, have the highest valuations. What we're seeing in this chart is there has been a reset that we're starting to see in the median valuation. So it sort of spiked in Q2 2023, and we're starting to see that come down. Hopefully we'll see some of that as well, because that means that it's going to be a better opportunity for investors coming into the marketplace, because the returns on paper will be greater later on. All I want to point out in this area is California by far leads in terms of issuers, in terms of investors, in terms of checks written, in the total amount of capital committed. And so the charts that I'm not going to go through really point out like the West is going to be stronger, partially because California is leading and all that. And so this just shows you by, deals, dollars, and checks written, California, far outlier. Florida, New York, and Texas are the ones right behind it. Now, if you study what happens in public markets where investors are and where they deploy capital, well, California, New York, Texas, and Florida are also the biggest states for what happens in terms of where investors are deploying capital as well. So I like to see the logic that flows through in this. Let me just jump over this. This is where showing you where capital's been flowing around the country. So you can see there's sort of centers where sort of parts are getting a lot more capital around the country, but you can see it's happening everywhere. What's that average raise by region? Investor distribution, it sort of looks the same as the other one. But of course, the coasts have more investors than the middle part of the country. I'm in Colorado, so it's nice to see that little mark right there in the middle where there's a lot of activity. We do see a lot of deals here in Colorado, which I think is great. And you see Hawaii has been phenomenal as well. There's been some really cool companies that have come out of Hawaii. And one of the things that we do is we've got this CClear Crowd Finance 50 index, which tracks the top 50 offerings on a daily basis. And what's important about that is it's another gauge of investor sentiment. So as the index rises, it means that there's a lot more interest in the biggest deals and a lot more capital. So we've seen this sort of spike in 2021, and it's sort of stayed in this sort of band here at the far right over the past few years. I think, we're probably going to be being in that band for a little while longer. This is a cool little thing. It's not all equity deals. A lot of people like to refer to regulated investment crowdfunding as equity crowdfunding. I like to point out that there's no restriction on the type of security that issuers can leverage. And while we do see a preference for equity, there are debt and revenue share deals that are very attractive. I think there's a huge opportunity. While we've got a venture fund that is focused on these equity deals, one of the other things that we've been talking about is starting a second fund that will invest in debt and revenue share deals. Because I'll tell you, as the Fed increased interest rates across the board, that had a trickle-down effect, and these issuers were paying higher interest rates to attract investors. And it's been around 11, 12% for the past several months. That's a great yield. And so I think there's an opportunity to have a fund that invests in these a broad selection of companies. And by the way, the default rate on these debt offerings has been relatively low when we talk to the platforms like Honeycomb, SMBX, and Mainvest. So I think that's another positive signal. WeFunder has been by far the largest in terms of the number of offerings, investors invested amount. Start Engine's right behind them. I think they stand to grow as well because they acquired Seed Invest. So they have all the investors. We'll see if that means that they will get the same amount of money committed. And Republic is right behind them. But, there are over 120 platforms that have registered with the SEC and FINRA since the industry got started. There are 83 active ones now. And now this sort of gets to the end of what I'm talking about. I'll just tell you, tomorrow we are having a sort of an introductory how to invest in regulated investment crowdfunding offerings webinar. So if you're interested in that, it's 90 minutes. You can go to cclear.ai/join and register for that. And then if you've got questions, reach out to us. We publish a lot of reports. From a weekly tear sheet to a bi-weekly report that shows you trends that are happening on a bi-weekly basis, to a monthly report that breaks down what's happening on a monthly basis and quarterly basis. That also has an industry deep dive in it. And of course, we've got our annual report. So, this is a really cool thing that we just came out with. If you don't want to do your own diligence, we have tools like the Capital Pulse that allow you to see, really what our algorithm is showing as the leaders for the weekly basis. And so we publish this on a weekly basis for investors to have access to. And that's it, Brian. So
no, Woody, this is fantastic. I think the trend lines are very encouraging for those of us who are working in the industry, and I think it's a great message to both folks who are looking to potentially become issuers, on the investor side, for policymakers. I mean, all around, it's a very encouraging, and it's great that you're capturing these statistics in a way that show that people can help make decisions on. We have a couple questions, and I want to get to those. One is by Devin Thorpe, who's our treasurer at CfPA and our past president. And so he asked the question, something that's being deliberated right now at CfPA. He says, if the CfPA advocated for 1,000 per person tax credit that was dollar for dollar invested in Reg CF, a couple questions. Would that drive more investing via Reg CF? Would this increase in small business funding drive more hiring, more jobs? And what sort of resulting prosperity would come of it? In particular, do you think it would pay for itself? Because that's often a question that policymakers have before they implement any type of tax reform. So again, the idea is that people could invest in a company that was on one of the intermediary Reg CF platforms or broker dealer, but a Reg CF deal, and get a tax basically rebate on that. What sort of impact do you think that could have, Woody?
I mean, so that's like an additional $1 billion that would be invested into the industry. So I would look at it from the perspective, if $2.2 billion has led to $6.8 billion of economic activity right now, this will far pay for itself because it's probably 1 to 3. So it's probably got a 3 something X return on it. And I think that's, the value of it, not to mention all the jobs that it will also create and support as well. So I think I like it because it's different from a lot of the other sort of rebates or incentives that I've seen, particularly coming out of the UK. And so, anything we can do like this, I think gives investors another reason why they should be getting into the marketplace.
And I think Devin did some back of the envelope calculations. And if you have over 100 million households in the US who are paying taxes and they all decide to do it, then you're talking about 100 billion plus that could be potential total amount that could be invested in this way. We have a more general question for someone in the audience, and that is, in your view, what do you think is needed for this really for regulated investment crowdfunding to hit the mainstream?
I think there's two things, and they're tied together. It's market awareness. So we need to do a better job as an industry of getting CNBC, MSNBC, Bloomberg to be really carving out an area to focus on this industry because it's growing. The fact that we've got 2.2 billion invested means that it's substantial, and there's a story in there. As a matter of fact, there's 6,800 stories in there right now. And I think there's a lot to be said, but what we need is these little average investors to become millionaires. Because our media just will not talk about anything other than, horror or, rags to riches. And I'm not happy about that. But I hear it over and over again. Like, what is the drama? Like, give me the drama and we'll do the story. So we need to have that excitement so that we can go to these media outlets and have them start covering it, because that will lead to more awareness, I think, for this industry, more issuers coming in, more investors coming in as well. Because if you walk down the street right now and you just say to someone, have you heard of regulated investment crowdfunding? I guarantee you 99 out of 100 have not.
Right. That's the media definitely has a role to play. And I think we have a role to play in helping media learn about some of the success stories, which we're working to do. What do you know that the House recently passed HR 2799, I believe it is, on Friday, which has a number of provisions that would affect the industry. Do you have any comments or thoughts on that, or is there any particular provisions that you care for or that you don't?
That was put forth a while ago, and it was just reintroduced, and it just passed the House, and I was thrilled to see it passed. NASA, which is the National Organization of State Securities Administrators, not our space shuttle people, wrote a scathing rebuke to it that was based on FUD. It was just fear, uncertainty, and doubt. There was not one data point to back up what they were stating, why Congress should not pass that bill. I was so mad that they did that, that I just wrote a rebuttal line for line for what they said would happen with data that proves that their entire arguments were wrong. And why it should pass. So I was thrilled, and I sent that to everyone on the Hill that they sent their letter to. So I was thrilled to see that Congress did vote in favor of it, but you have to look at the numbers again. Regulation crowdfunding passed 407-17, and it had President Obama saying, "I want to sign this into law." HR 2799. 2977 does not have Biden saying, "I want to sign this into law." And that's why when you look at the vote split, it was very partisan. It was bipartisan in the sense that there were many Democrats or several Democrats that did come over to vote in favor of it, but it did not have the same type of bipartisan support that the Jobs Act or regulated investment crowdfunding did at the time. So I would love to see it go into effect because it would raise the caps up to $10 million. I'd love to see that go up to 20. But I think, the hopes of it in the Senate are few. We'll see if we can get some, Democratic senators to look at it as an opportunity. And I think that's, again, where the data comes in, because I think they need to see what the data is showing as a reason why they should vote in favor of something like this.
So Woody, we could go on all afternoon, but I want to thank you for your participation and wrap up. You have information here on how people can reach out to you. So that's fantastic. I also just want to acknowledge our sponsors for the webinar series, which includes Dealmaker and Crowdfund Holdings Innovators, a couple companies that are sponsoring the CfPA webinar series. For others that want to get involved in CfPA, again, visit cfpa.org or the crowdfunding ecosystem. And Woody, really appreciate you doing the work that you're doing to get this data out there, because without the data, we're sort of driving blind, many of us. And this really creates a compelling arguments for why this is such a beneficial thing for the country, for investors, for entrepreneurs, and really excites us to see that. So thank you again for participating. Thanks everyone for attending. And with that, we'll close that out. And I'll see you in the next events.
Great. Thanks, Brian. Thanks, everyone. Talk to you later.
Bye, everyone.